Waiting on the inevitable, that's kind of the key theme that I have here. I'm going to show you some of the reasons why it is inevitable. And this is a primary one. Gold is money. The monetary application, the monetary use, the monetary role of gold is the primary reason why we're going to see this inevitable rebound in the markets and why it's going to be so powerful. I know later on today John Kaiser is going to come up here and counter just about every argument I have, but reach the same conclusion that it's not necessarily the monetary use of gold, but he has other reasons. He's not as much of a gold bug, but he has some other fundamental reasons why, but we all end up in the same place. This market is going to come back, and this is a time when the real fortunes are made. Gold is money, that's it. Famous quote by J.P. Morgan that he may or may not have actually said. That's why I have the asterisk there. And there's a story behind that that I won't go into right now. The correction and bottom, I'm going to cover that. The near-term prospects, long-term prospects, and a couple of wild cards that are in play in gold that could really take us much higher. This could actually be the big run. This could be better than anything we've seen before for a number of reasons. Let's look at the correction in the bottom. What we have here is the history of this gold bull market going back to, actually going back to the early 70s, late 60s. These are the big runs in the market. So there we have the 1980s. That's the run we have. When you look at this big grand sweep of history, this is certainly very dramatic, what we saw since 2011. But this torture that we've been living through over the last few years is barely a blip on the big scheme of things, and it's been repeated over and over again, and we've always come out of such situations. This is gold over the last year. You can see that last year, and hearkening back to somewhat of what Gwen said, back last summer we got up to around 13, 14 in that little springtime run. We all got excited, but then whammo, it hit us again. We had a little blip here. Actually, earlier this year, we got excited again. We had a little blip, as I'll show you now. Over the last few months, a couple of weeks ago, we got up to 1225 and then got smashed down. But generally, the short-term picture is that we're running in a range between 1180 and 1220. That's kind of a solid level where we're at. I'll go into some other reasons later on, but Gwen brought them up. The all-in sustaining cost of production are one reason why we're kind of around the bottom. If you look at some of the really smart people in the industry, people like Ross Beatty, Rick Rule, Rick has been the guy that at my conference has always come up in the podium and told everybody why they're so stupid to be involved in this area, in this market. They need to sell, sell, sell. Don't be buying these companies. He's buying hand over fist and has over the last year or so. Nobody out here, nobody in the market that knows how to play the cyclical nature of the market's better than Rick, and he's buying anything he can, of course, at Rick Roll discounts. Gold Bugs Index. You've lived through this. Again, we're around a long-term bottom. We all know that we're around a long-term bottom. Prices for the metals can go lower. They can go lower than the cost of production, but they can't go much lower for very long. So we have a general feeling here that our downside is maybe 20%, you know, knock on wood, but our upside, quite literally, for even the least speculative of the juniors, the companies that have identified resources, are fairly solid, fairly stable. These things can go up 200% if we just get up to, you know, those kind of 1,350, 1,400 level prices that we had not long ago. We don't have to have a huge, big bull run for there to be tremendous profits to be made in this sector. So that's a Gold Bugs Index. The junior gold miners, the same thing. We're bouncing around the bottom. What we're looking for is when will we come out of this? Let's look at our near-term prospects very quickly. The US dollar index. This was a killer for us in the industry. As you can see, that huge run, 27% from trough to peak in the US dollar. over the long term, I think the US dollar index is irrelevant to the gold price because gold is priced against the dollar every single day. It's really that when we get into a major bull run in gold like we saw in the 2001, 2005 time span or the 1970s, gold starts rising against all currencies, all fiat currencies, and that's when you have these really powerful bull runs. In the meantime, though, over the short term, the speculators, the Western speculators that set the price of gold on a daily basis do follow the dollar index, and it does have an effect, as you'll see, on the metals and primarily on the other commodities. This, again, is a US dollar index. You'll see this is the big spike in the Swiss franc. These are all of the other trade currencies that are plotted against the dollar index. So the dollar has been the dominant story for some time. However, the dollar index is primarily the dollar versus the euro. Now here where we see with the dollar rise, this blue line is the dollar index. You see it going up. You see the Thomson Reuters commodity index, what that's done, and that includes all of the base metals, some of the sauce. And when we had that little drop there in the dollar, an instantaneous reaction in the commodities, very direct correlation. Here we have the US dollar index versus gold. You'll see a general correlation that you'll have a general downtrend in gold as the dollar made that uptrend, but gold has not suffered as much as the other base metals and other commodities against the dollar index. Part of that is the safe haven nature of gold. This always seems to be an issue these days. It tends to elevate it. But again, gold truly valued is valued against all other fiat currencies. Very short-term pictures. These are weekly charts. Interestingly, these charts come from the chartstore.com. Good friend of mine, Ron Grease, does these for Gold Newsletter. On the weekly chart basis, gold hit a few technical buy signals over the past couple of weeks, but these are weekly charts. They do not incorporate, say, the drop. I think it was about an $18 drop we had last Tuesday. So it's not really short term. So these buy signals may, in fact, still be in effect, but they're somewhat weaker than they were a while back. We have a tightening of the Bollinger Band here that tends to precede a breakout. Here in the stochastics, we saw an uptrend that still may have some length to it. So in the short term, we have an improving technical picture for gold, but it's still not conclusive as yet. Same thing for silver. If you look at the support lines, 1478 on the downside, resistance is around 1870, which seems a good bit away, but silver is actually also on a short-term buy signal right now, according to these charts. In summary, the recent mini rally that we saw about a week and a half ago has lost some momentum this past week. We're now entering the summer doldrums. The economic data is something I've been watching very closely. I was convinced, as were a number of other people, that first quarter GDP in the U.S. was going to be negative. It turned out to be significantly negative. What we're tracking now is the second quarter GDP. That's another big story right now. If the second quarter comes in at a negative, when you have the technical, therefore have the technical definition of a recession in the U.S., then I think you can very safely put off any Fed rate hikes until well into 2016. I don't think we're going to see that, though, because second quarter GDP is tracking around 0.7% growth right now. Still pretty fragile, but the results have been mixed. We've had good news with bad news, not a solid trend there. So looking at all of this, you would think going into the summer doldrums that the story's a bit negative for gold. But gold moves when we least expect it. It loves to surprise us, not only moving when we least expect it, but for reasons that we never foresaw. So I really think we're set up for some surprises in gold. Let's look at some of the long-term prospects for the metal and why I think the picture is so bullish over the long term. Now, we've been through a long term. We've been through over 3 years of a market bottom right now. So we're from a cyclical, from a timing standpoint, we're looking at a good time for a turn. The long-term picture, though, for gold that I think make higher gold prices almost assured is the debt picture, primarily in the U.S. It's really a global thing in the Western world, but in the U.S., the federal debt's already too large, and it's still growing too quickly to address through spending cuts or economic growth. There has to be some debasement of the currency, debasement of the dollar, to handle this debt load over the long term. The Fed's QE and easy money policies created an enormous overhang of money. I'll get into that in a minute, and potential inflation, and there's not going to be any easy exit from this. Here's the gross federal debt, the growth rate, the actual growth rate long term since the institution of the Federal Reserve is 8%, 8.8%. It's reaching $20 trillion before President Obama leaves. We thought that was far off into the future. It isn't. Gross federal debt as a percentage of GDP, 102%, 102.5%. That used to be the benchmark for a banana republic on the edge of default. We're now the standard bearer. And that's actually very good in the Western world, but it's still way out of control. Gross federal debt, here we see what happened if gross federal debt grew in World War I, the Depression, World War II. Here's when the implication or the institution of, say, the Great Society, fiat currency, the elimination of gold from dollar backing in the 1960s. Here's what happened to gross federal debt. We didn't have the excuse of fighting world wars. We didn't have the excuse of a Great Depression. This is all profligate spending beyond our means. And this necessitates at some point a devaluing of the dollar. And actually, it has happened over the long term. Here we see the gross federal debt year-over-year change. This was around 2009 in the stimulus package, quantitative easing, et cetera, et cetera. That was unsustainable even over the short term. We've dropped down to these levels, but interestingly, if interest rates in the U.S. are normalized to some extent, if they get up to 4 to 5%, just the burden on the federal debt where it is right now will bring us right back to these unsustainable levels. That's why the Federal Reserve cannot significantly raise rates. So while we'll have to get over somewhat of a shock when they eventually begin rate hikes, we will be in a low interest rate environment that's positive for gold for the long term, the very long term. Total assets of the Federal Reserve System soared when it began quantitative easing. Operation Twist leveled off, then QE3, they leveled off again, and they, of course, stopped. I'm going to show you what this meant. This was supposed to be a refunding, rejuvenation, supposed to spur economic growth in the U.S. In fact, all it did was blow up to record proportions financial assets, primarily equities and bonds. This is the S&P 500 in the black line plotted against total assets of the Federal Reserve System in the blue line. The correlation coefficient is 97.5%. Direct correlation between the Fed easing and the stock market. Here we have gold versus the total assets of the Federal Reserve System. This reinforces a point that I like to make, that the price of gold is set in the West by Western speculators. The demand for gold is set in the East. The world's divided into two halves in the world of gold, for gold. Western speculators pricing it in the paper markets, the Asians taking advantage of the price and buying it. Here we have the institution of QE3, unlimited QE, and you see what happened to the gold price. Virtually straight down. That's because the speculators got out of the market. The next announcement that they were going to see from the Federal Reserve was that QE was ending. So they got out of the market, they got out of GLD, and that's what happened to the gold price. I'll show you in a minute that what the Chinese did in reaction to this. M1 money supply, parabolic rise, purchasing power of the consumer dollar. This is what happens over a long-term depreciation of the currency. When you get to something like this where it's steeper, that's where we're going to have to see at some point to handle the debt load we have right now, and that corresponds to what we saw in the 1970s. U.S. bank reserves, about $2.65 trillion overhanging the economy in bank reserves. At some point, this has to hit the U.S. economy. It's not money right now. When it does, you'll see retail price inflation spark. Alan Greenspan at my conference said that what this means is that we have this huge potential inflationary explosion tinder, but it's not been lit. When that money hits the economy, the U.S. economy, it will be lit. And that will result in the kind of a thing that historically moves the precious metals. So in summary, the Fed's painted into a corner. Global markets and investors are addicted to quantitative easing and zero interest rates. The equity markets are. They're trying to get used to this idea of Fed rate hikes. There will be some sort of an event, a market event, when the Fed does begin to raise interest rates. Greenspan actually told me this in a private conversation at my conference, that he thought that there's no way we can exit this era of quantitative easing without some type of a major market event. So we have that to look forward to. Gold will, of course, respond well in that in reaction. Rising interest rates will blow the federal budget. Rates can only go so high over the long term. Continuing policies as we are now only exacerbates the issue, only makes it harder to extricate ourselves. Every option that we see going forward will lead to higher gold prices. Now, there are a couple of wild cards here I'd like to go over. One of which really isn't a wild card, but kind of a standard, a fundamental foundation for the gold market that we have right now, and that's China. Here we have GLD holdings versus the price. We see that when the price of gold went down, GLD holdings plummeted. It wasn't the holders in GLD weren't quite as sticky, long-term holders, as we had hoped for. What happened is that this chart tracks the total published repositories, mutual funds, ETFs, et cetera, of physical gold and their holdings, how they dropped when the gold price dropped. And I use this as a proxy for Western gold demand. And what we see is that as the price dropped, the trend-following speculators abandoned the market, got out of the market. We've seen, however, that we've reached kind of a base. The ETF, this is the total holdings of these ETFs. It's kind of leveled off. We still have some withdrawals, we have some additions, but I don't think it can go much lower. The people that are still in these ETFs are fairly strong hands. So what happened, and this is over the longer term than just this reaction that we saw, but here we have in blue fabrication and investment demand for gold from the West. And we see that it's generally fallen off. But if you look over the long term, the East, it's actually grown and continue to grow. Asians are buying gold hand over fist, and even more intensely over the last year and a half, 2 years than ever before. How do we know this? The Shanghai Gold Exchange tells us this with their weekly reports and withdrawals. Shanghai Gold Exchange, as Koos Jansen, who blogs at bullionstar.com, he's really the guy on this. He tracks this on a weekly basis, but he's proven that this is a very close proxy for Chinese gold demand, domestic gold demand. We see that it's soared, especially since that drop or that attack on gold in April of 2013, when the Western speculators dropped it a couple $100 an ounce in a flash. The Chinese started buying hand over fist, and they haven't slackened off. Surprisingly, I thought this level of demand would drop off, but it hasn't. It's kept up. Here we see each year's demand. This is 2013 cumulative demand. This is 2014. If you were to listen to the World Gold Council, they would have told you that gold demand fell off from China by 50% last year. In fact, it fell off only 4%. This year, we're running 9% ahead of where we were in 2013. And actually, we could beat it substantially, to a substantially greater degree. Again, another chart, East versus West gold reserves. World gold reserves, official gold reserves, reached a bottom, then they started rising. The red line is Asian reserves as a percentage of total gold reserves. Another chart showing China's gold accumulation. This is historic. They're buying it hand over fist again. Here's what's happened to the Western gold stocks. They've reached what has historically been a very low level. This implies is only 370,000 ounces of gold backing all of the COMEX gold contracts right now. This implies that one holder could come in and take a max position contract and virtually wipe out all of the COMEX gold supplies backing the contracts if they took delivery. I doubt that would happen. I doubt that they would mobilize gold to fill that, or they would change the rules. But it's still the kind of an issue that the last time we were around here, it propelled the gold price up to around $1,400. So that's another short-term issue we have right now. There are 110 claims right now for every ounce of gold traded on the COMEX. 110 investors that have a claim on each ounce of gold. It's gotten as high as 150, so we're in that kind of a era. I'm going to run through these very quickly. The other wild card I see is some kind of a market turmoil. In particular, the S&P 500 is going, and really this applies across all the major indices. There's an ascending wedge that looks like we're getting to the end. The market's getting tired at some point, and most likely as the talk of Fed rate hikes continues, there's a potential for a major setback in the U.S. stock market, and that would be positive for gold because the U.S. equity market during this run has drained a lot of speculative fuel away from the gold market. And I'll end here. This is a chart of the real gold. I put this up in all my speeches to show people where we need to be, where we would go if we equaled the market of the 1970s. And really, if we equaled the price of $850 in 1970, or actually January of 1980, in current dollars, that would equate to $2,546. So just equal the 1970s, just to set a new record in the gold price in real terms, that's what we're looking at. And the companies that that you're listening to today would be trading at vast multiples of where they are right now if we saw that. But again, if we have a move in the gold market to $1,300, $1,350, $1,400, which is very likely in the near term, the companies you're talking to today would be trading, I think, for an easy multiple of where they are today, just in that kind of a move.